Well, look, long term, I think this is a 10-year trade. I think 99% of investors have 100% of their money in fiat denominated assets, and they're waking up to the fact that that is a bad idea long term. So long term, I think this continues for 10 plus years. You're seeing that at the largest institutions in the world, right? 2 years ago, central banks owned more US Treasuries than they did gold. Today, they own more gold than they do US Treasuries. 2 years ago, the Harvard Endowment did not have gold or Bitcoin in its portfolio. Last year, they put on a big trade buying both. So I think all investors are moving from wanting to be 100% fiat denominated stocks and bonds to something else that has hard assets.
Hougan frames Bitcoin as a 10-year trade, driven not by hype, but by necessity. The foundational issue is that fiat-denominated assets dominate global portfolios to an extreme degree. Stocks, bonds, and cash are all ultimately claims on governments and central banking systems. Over long horizons, that concentration of exposure becomes a vulnerability rather than a feature. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
So the 10-year trajectory, I think, is very strong. That's one of the reasons we launched BPRO, our debasement ETF. In the short term, those charts look absolutely ridiculous, right? I mean, just straight up to the moon. They look primed for retracement. That doesn't mean that retracement will happen tomorrow. I'm not making that claim. I don't know. Short term, I'm mixed. Long term, I am bullish. It just depends on your time scale. I mean, two things. One, I think demographics are on the side of Bitcoin. So if you're a central bank planning for the next 100 years, are you betting on digital or are you betting on physical? Are you using Spotify or are you using records? I think people will wake up to that and want some hedged exposure. But the other one is building off of what Ryan said. Bitcoin's a fundamentally better technology in a way that central banks will realize soon. As you mentioned, LG, the reason central banks are buying this is they don't want to store their wealth in an asset that depends on someone else. They used to own US Treasuries. The US government seized Russia's treasury assets. Central banks freaked out, said, I want to own wealth in a way that the US government can't seize it. And the answer for them was gold. Great. The challenge with gold is once you want to move it or spend it, your self-custody ends. You have to put it on a boat and send it somewhere, or you have to store it in a centralized vault and have a tokenized version of it where we're relying on that centralized vault to safeguard it in a way that's not subject to seizure. Bitcoin has self-custody through ownership and settlement. So you can self-custody it until the point that you give it to someone else. And gold just literally can't match that. There is no way to disintermediate moving gold from one place to another without weakness in the supply chain. So long term, as central banks go from just like a freak out around holding wealth in an asset that can be seized, they freaked out. Now they want to hold it in a way that they can self-custody to a world where they can use it. They're going to realize that Bitcoin's ability to serve that is just infinitely better, binarily better than gold's. And they're going to move to gold. You're already seeing that. You're seeing talk about a gold-based alternative to dollars that banks can use to settle transactions. It's not going to work in a world that doesn't trust centralized institutions. Bitcoin is the only one that provides self-custody through holding and settlement. And for that reason, it's the ultimate end in the journey. How fast we get there, I don't know, but that's where we will get eventually. Imagine you're pitching Bitcoin to someone and Bitcoin were half the size of gold. And you're saying, it's half the size of gold. I think it'll get to be as big as gold. And they'll say, wait, this is an asset that no one trusts. It's only been around for 15 years. Why is it half the size of gold? Everyone owns gold. Central banks own gold. It's a hard pitch to make. Like that increment to invest when it's half the size of gold to get it to be gold at this stage in Bitcoin's development doesn't feel right. And then imagine you're at the other side of the spectrum. You're like, this is digital gold. It's 1/30th the size of gold. If it just becomes 1/15th the size of gold because people like Ryan get older and make more money and start adding to more Bitcoin, then it's a double. That's like such an easier pitch. I love that we can go to people right now and talk about Bitcoin as like 5%, sub 5% of gold. That's great. Like it was actually a little bit harder when it was 10% of gold, right? Because you're talking about this asset that people don't know and trust. It's already 10% of gold. That's like pretty good. Is it really going to get to 20? That would be like a big, if it's 5, if it's 3, if it's 2, it's like really easy to argue that it could double, triple, quadruple and still be emerging as a new asset. So for me, it's just strictly good. Will the Momo money really roll directly out of gold into Bitcoin? I'm with Ryan. Eventually, some of it will, some of it won't. But the bigger picture to me is this larger TAM is just strictly good. If gold was $100 trillion and Bitcoin was $2 trillion, I'd feel like we were back in 2015, right? And be like, oh man, let's load up the truck. So I'm all for this run. I think it's positive. I think we've been through a full-on bear market in crypto over the last year. To put that in context, if you look at the returns of most crypto assets over the last year, Bitcoin was down like 5%, ETH down about the same. If you look at just slightly out the alt curve spectrum, you're talking about assets that are down 50, 60, 70%, right? Massive bear market. That's why it feels so bad. Bitcoin went down 5%, even though corporations and ETFs bought 700,000 Bitcoin. Even though we shoveled $70 billion into the Bitcoin coal mine, we couldn't keep us from going down by 5%. So absent the ETF and corporate purchases, this would feel like 2022 or 2018, full-blown bear market, everything down 40%. What does that mean for this patience? When you come out of a bear market, it's a rounding. You never come out of a bear market with a V. It never goes straight back up. And so my actual expectation is, look, we are behind the fundamentals. From a global money supply, from a Bitcoin versus gold, we should be higher. But the process is going to be more like a rounding than a V, is my base case, because we're coming out of a full-blown bear market. I think that's the market we're in right now.
Hougan highlights a subtle but powerful psychological dynamic in Bitcoin's valuation relative to gold. When Bitcoin grows large relative to gold, it becomes harder to pitch incremental upside. If Bitcoin were already half the size of gold, investors would reasonably question how much further it could go. But that is not the current reality. Bitcoin remains a small fraction of gold's total market capitalization. At 5%, or even lower, it is far easier to argue that Bitcoin could double, triple, or quadruple without displacing gold entirely. It can simply coexist as an emerging monetary asset.
And I think the public has this generally viewed wrong. I think the public perception with gold is like it walks around in a pinstripe suit with a monocle, and it's the most established institutional asset in the world. And that's funny to me, because if you remember or you study or you read about gold in the 80s, 90s, and 2000s, it was the opposite. Like gold conferences were like Bitcoin conferences in 2010. You would go there and it would mostly be like your cranky old uncle and then a few people gathering pens and people wearing dirty teeth. It was like the least institutional asset in the world. We labeled people gold bugs and we thought they were crazy. In fact, central banks started selling gold in the late 1980s. Because we were in this new globalist world where we relied on the dollar as the backbone of all wealth. They sold gold and bought US Treasuries. They were selling so much gold that they were disrupting the market. And the G20 central banks got together and entered into a formal agreement called the Central Bank Gold Agreement, CBGA, that limited the amount of gold they could all sell in a year because they didn't want to disrupt the market. And they did this for 5 years and they were still dumping gold. So there is a CBGA 2 in 2004. And they did it for another 5 years and they were still dumping gold. And there was a CBGA 3 in 2009. In practice, in 2009, post the financial crisis, when we printed just an absurd amount of money, actually central bank gold sales flipped to positive. So the first central bank purchase in like 2 decades, the net purchase occurred in 2009. And then they tripped along at like 400 tons. They started being a little bit buyers, mostly in emerging markets, until Russia seized the US assets and they rose 150% to 1,000 tons a year. But the point of this story is that gold went from really being completely forgotten, called a barbarous relic, in the dustiest, saddest convention halls in off-strip casinos in Vegas. That was what gold was. With central banks selling so much, that they had to form a consortium to limit how much they sold, to now they can't get enough of it. Now they're buying it in spades. And I think the story you should take from it as a Bitcoiner is that attitudes can change. And I think the attitudes toward Bitcoin are changing at central banks. We've done meetings with central banks this year already where they're thinking about Bitcoin. And eventually they're going to add Bitcoin to this mix. And then eventually I think they will add more Bitcoin than gold. I think that's the direction of travel. And anyone who thinks that impossible doesn't remember when we called gold holders gold bugs and sort of belittled them in the financial media. I've described the Clarity Act as the Puxatawny Phil of this crypto winter. It's the groundhog. And if it doesn't pass, it will go back into its hole and we'll have another 6 weeks of winter. That doesn't mean there won't be spring. It just means that there'll be a setback. I'm sort of a Clarity Act maximalist in that I really want to see it passed in a good format. The reason I want to see it pass is if it doesn't pass and then we head into the midterms and then we get a change in administration in 2 years, we could have Elizabeth Warren running the SEC. And that doesn't sound so great. So I would love to see this positive regulation get put in place. But do we need it to rally? No, I don't think we need it to rally. I just think it changes the shape of the rally. If it passes, I think we pull forward a lot of value. If it doesn't pass, I think you have to see the fundamentals get even more ahead of price. Ultimately, I think the market gets to the same place. But I do think the shape of how we get there is pretty different. It stinks, though, that we're here in crypto. We're just trying to build a better financial ecosystem, and we're being held hostage and spending time on like the U.S. government politicking around should it stay open and pass this bill. It does seem absurd to me. I do think the world looks at particularly tokenization, but also stable coins to some degree as fait accompli, that they've just accepted that the world is going to run on blockchain-based rails. And it is only a matter of time until that happens. And that's why you're seeing those things. So yeah, if you zoom out, we're in a generational bull market in crypto and blockchain, and that remains the case. We focus on these short-term things because they do influence the short-term price. But yeah, Wall Street is still building, and importantly, they're building on public blockchains. I think that part of the Fidelity announcement is really notable. They're the third largest financial firm in the U.S., I think. So they're not like a small pup. Look, I think most people hold stable coins for functional reasons, and it remains the case today that functional dollar-based stable coins are a better bet. Which one will hold its value more over the next 10 years, I would bet in gold for sure. But for functional trading purposes, the liquidity in dollar-based stablecoins is still through the roof.
When you zoom out, Matt Hougan's message is clear. Bitcoin is not defined by this quarter's chart or this year's headlines. It is part of a generational reordering of how value is stored, transferred, and protected. The world is slowly moving away from exclusive reliance on fiat systems and toward a hybrid future that includes scarce, self-custodied digital assets. The path will not be smooth. There will be bear markets, regulatory delays, and long periods where price lags adoption. But beneath the surface, institutions are reallocating, central banks are reassessing, and financial infrastructure is being rebuilt on blockchain rails.